Let me first start with a little bit of housekeeping to take care of. Um, there are a few items of Venco's fund forums that we'd like to flag. A little bit about where we're coming from, so you get some context on Bloomberg Intelligence. But the focus today is going to be on getting insights from experienced investors and asset allocators as it relates to the macro environment as well as positioning in for 2026. Evenco, just to mention up front, the organizer of today's webinar has great in-person events beyond these trend watch webinars. There's 19 of these fund forums that are lined up for 2026. They range across Europe. I'd encourage anybody to go to Evenco's website to take a look for details. And there's also some very interesting fund flow analysis that they do with Evenco analytics. I'll use a little bit of that in a bit. And for a little bit of context, Bloomberg Intelligence, where I'm from, a full-blown investment research business across the Bloomberg terminal. If you have the terminal, you have us, the 500 of us across markets, sectors, regions, and we're happy to engage and connect. Now, let's go back and get a little bit of an intro. As I said, I'm one of the research directors at Bloomberg Intelligence, but more importantly, let's get a little bit of perspective from Rose, Eduardo, and Claudio in terms of where you're coming from, your current firm, what you're focused on, and then we'll get into the meat of our discussion. Rose, ladies first. How about yourself?
Great, thank you so much for the invitation. So I'm Rose Van Gerven, CEO of Finley Park. We're a boutique based in London, and we are very focused, singularly focused on North American public equities. So that's what we do. We live and breathe and watch. So we'll be coming from that perspective.
Very good. Claudio? Claudia, can you hear us? We seem to have lost your audio. I'll let you work on the audio for a second. Can you hear us? Can you hear us, Claudio? Oh, there we go.
Okay.
Super.
Fantastic. Okay. So, hello team, thank you for having me and good morning to everyone. I'm Claudio Basso. I'm based in Luxembourg and I work for the Azimuth Group. I joined the Azimuth Group 20 years ago as fund managers and over time I became a director and the chief investment officer for the group.
Very good. And Eduardo, last but not least.
Hi, thank you for the invitation. So my name is Eduardo Monteiro. Basically, I'm the Chief Investment Officer of BPI Asset Management. And in BPI Asset Management, we have two main focus. It's asset allocation and also alternatives, long, short, market neutral. So it's our specialties.
Oh, very good. Thank you very much for all three of you. It is interesting getting a group together in part from a fund company, in part from a broad-based asset allocator vantage point, as well as different venues from London, from London to Luxembourg to Porto. So let's dig into things. I'd like to start sort of unpeeling layers of the onion. If you think about it, start with the macro, and then we can get into positioning as we look into the new year. The macro backdrop in 2025, I think we could all conclude, has been about as volatile as we've ever seen. The ups and downs of what the market has expected economically, from an inflation perspective, from various policy pulls and tugs. I'd like to dig into what you're currently thinking, and I'll start by sharing another picture. Um, this just gives a bit of a view on this volatile period that we've had in 2025. These are economic forecasts for the US, Europe, and the UK. And clearly, there was an uptrend into last year, notably in the US. All hell was going to break loose with Liberation Day with the announcement of the tariffs. And interestingly, at least consensus forecasts at this point are back to where we started, which is kind of shocking when you take a step back at all the concerns that we've had. So let's dig into you all's vantage point and what you're thinking about the macro backdrop. Eduardo, you want to continue?
Okay, I will try at least. I will start with a phrase that is kind of common, that I'm cautiously optimistic. But basically, that's because we believe that the conditions in terms of macroeconomic growth are not in place to have a recession or a big drop in terms of growth. Basically, as we have the companies, the majority of the companies are pretty light in terms of debt, and also the consumers are not in debt. So we don't have basically the fuel to have a very big drop in terms of growth. So we think the markets have some concerns. We are concerned about the market. For instance, this now we are on the minimum of exposure to equities during this year. We were beginning to cut exposure. We were overweight until the end of September, and we are gradually trimming the positions due basically to the complacency on the markets, and everyone is optimistic. So that's the only reason that we are a bit more cautious. But we don't believe that we'll have big problems. So we will buy the dip, we will buy corrections because we think the companies and consumers are resilient to have a good 2026. That will be challenging for sure, with shocks that we are not predicting, but that's market. I'm here
Fair enough.
the last 25 years, so 2026 will be the same, I believe.
Yeah, and we'll get into some of that positioning for sure. But staying on the macro front, Claudio, how about yourself? Kind of the broad backdrop. Are you bullish, bearish, concerned, optimistic?
I will say that I'm quite aligned with what Eduardo just said. There are no particular reason for worrying about an imminent slowdown or even a recession. We have no sign about that, nor in the US or elsewhere in the world. But anyway, growth rate is moderating. We will have, on the other hand, the Federal Reserve that will likely start to cut rates, and this will underpin the growth in the US. But nonetheless, I would say markets are priced for perfection. I would say both in equities and in fixed income, there is little margin for any surprise. And probably what is a factor that everyone should take into consideration right now is that it is becoming a habit for government to intervene in the functioning of the free market more and more frequently. I would say this is no longer an habit of some centrally planned economy, like, for example, China, but most of the volatility that we had this year was actually caused by some decision by Trump, so a government decision about tariffs, about trying to force the Federal Reserve to lower rates, or to impose control in the export of technology. So we have to be aware that even if we cannot see any particular reason that we can name a particular concern, anyway, we should expect additional volatility also take place in 2026, maybe not because of economic or market reasons.
Oh, fair enough. And Rose, last but certainly not least, your take on things.
Yeah, so thank you for providing that chart. I think it's a great reminder of why forecasting is really, really difficult. And we don't actually, provide outlooks per se for that reason. But I have kind of joked internally that if we were to do an outlook, as we're sitting here on the eve of 2025, we might call it not outlook, but look out. And specifically, I think this pertains to the more speculative areas of the market. Whether that's unprofitable technology, areas of AI, crypto, etc. We've seen a little bit more choppiness in November, but this is off the back of an amazing rally from those post-Liberation Day lows. So we think there is more room for some of these speculative types of investment to unwind. And obviously, they've been a big driver or parts of them for the US market. So we as US investors need to be very wary and alert to that. So having started very much kind of glass half empty, I do want to make the other case that actually there are parts of the US economy and investment opportunities that we do see as resilient. And the other panelists have talked about the health of the broader economy. We do see that. I think healthcare is a really interesting example, actually, in that at some points this year, the weighting of NVIDIA in the S&P 500 has been not too far off the weighting of the whole of the healthcare gig sector. These are really important drivers of the economy, demographic change, GLP-1, etc. We know there are real opportunities here. So we do think there are fantastic investment kind of areas in the US that have maybe been a little bit overlooked and could again emerge as some real winners in the year to come.
Oh, super. And we will definitely dig into that a little bit more as well. I just have a couple of other elements that I'd like to get you all's perspective on when it comes to the sort of the top down, the macro vantage point. And I'll share a screen again. Bear with me a moment. There. So one is Fed policy. You all had mentioned this in your prior comments. Clearly, there is an expectation now that we are in an easing cycle. This is a screen off of Bloomberg, MIPR. The green line shows current market implied forecasts of where Fed funds are going to go. Getting back to the idea of how volatile this year has been, the implied policy rate back at the beginning of the year is that dotted yellow line. So it just shows how crazy and volatile the year has been. How do you see the rate policy backdrop shaping up for 2026? And maybe along with it, I'll shift gears. And how do you think that ends up having an impact when it comes to the US dollar? I know you all aren't necessarily currency investors per se, but currency impacts all the investments in various ways across asset classes. So I'd be curious to get your take on Fed policy. I know we've got a new Fed chair coming, as well as implications beyond dollar or otherwise. Rose, do you want to jump in on this one?
Yeah, again, I think we try very hard not to be overly predictive of what's going to happen from a kind of rate or dollar perspective. We think that's hard. We do have some assets that are more exposed to duration and rates. So anything the housing kind of environment, for instance. And there we look at a range of different scenarios. And we wouldn't invest in a company purely on the expectation of a certain rate outcome. So we try again to kind of build in some different scenarios and considerations. On dollar, it is obviously material, given that that's all we invest in. I would say, many of these businesses that we look at are somewhat global. So a weaker dollar can obviously help their exports, etc. And then we do offer a hedge share class to some UK investors. But again, currency famously difficult to predict, and we try not to get kind of overly wrapped up in these debates.
Oh, fair enough. Eduardo, Claudia, curious what you all think. Whoever wants to go first.
I can go second. So basically, in terms of policy, I think it's fair what is priced in the market, because inflation, it's trending lower. It's true that eventually everyone would like that service inflation will go down a bit faster. But the way that the several puzzle theory on employment, we have more challenging employment, so probably wages will be stable or rising not so fast that they've rise in 2025, and besides that, the fact that we have a boom on AI. We were going to see productivity, and that will help keep the prices a bit lower than it could be otherwise. And we have shelter pushing inflation down. So I think it's reasonable to expect the 3.5 cuts since now until the end of 2026. Regarding dollar, we are underweight dollar. We have currency positions, and basically since the paper of Stephen Mirren on November 2024, we began to be afraid about dollar. The economic advisors around Trump, they are pretty strongly in favor of a stronger currency of the other world, so with a not so strong dollar, and that can help bring employment, industrial employment to United States. And regardless the fact that Trump seems to be a kind of aleatory guy that says a lot of things that do not make sense, when we took like a helicopter view, those economic advisors make sense, and they are doing the best they can to make the dollar goes down. And I think some critics about Fed have the collateral impact of lowering the value of dollar. That is something that clearly they want to appeal to their political base.
No, fair enough. And Claudio. No, we've lost you again, it sounds like. Fingers crossed.
Okay.
Ah, there we are.
Okay, I will leave always my microphone open, because every time that I close the microphone, then it stop work.
Oh,
okay. So on my end, I will say that under the Powell's Fed, probably we won't have as much cut as the market is expecting. Under the new Fed chair, Fed, probably the market is quite correct in its prediction, because on the one hand, we have to acknowledge that probably we have not yet seen in full all of the impacts, the pass-through from tariffs. So probably inflation will remain not at a very high level, but slightly above the Fed target for a while. And on the other hand, with valuation already so high in the equity market and spreads so compressed, cutting rates is anyway something that is supportive for financial market and easing financial conditions. So I would say that a Fed like the one we were used to be would have not cut rate that much in order to prevent even more euphoria on the market. As the new Fed chief will clearly be very aligned with Trump's desire of having rates cut as much as possible, I suppose that we will end up with rates that will be probably 75 to 100 basis points lower by the end of next year. And in terms of consequences for the dollar, there has always been a clear link between the rate differential in the short end of the curves and the US dollar. So if the Fed will cut rates quite aggressively, we can expect the US dollar to continue to weaken. And probably the biggest beneficiaries will continue to be like 2026, the euro, where we are not expecting that much movement from the ECB, and the emerging market currencies because of carry trade.
Oh, very good. Let's shift gears and head more into how do we actually implement you all's policy perspective, or you all's perspective when it comes to actually positioning your portfolios. I'd share a couple of things here that I think help set a bit of a stage. Interesting work that our friends at Avenco do. I had mentioned the Avenco analytics data. This is a data set that looks at European funds and projects forward over the course of the next couple of months where funds flow will be headed. And certainly their work would suggest that if you take all funds and look across different geographies, that what we're seeing on the left-hand panel is a heavy overall fund flow into Europe, ex-UK, along with the European regional perspective. And certainly growing flows towards the US. You can see the percent changes on a monthly basis on the right-hand panel, and there you start to see some changes of note in some of the emerging market areas. But those are notable percent changes, but on very small basis, as you can see. If you look specifically within equities, I thought this was particularly notable. A few months ago, there was pretty heavy flow from a European perspective relative to the US from a historical vantage point. But over the course of the past couple of months and looking into December, it seems to be shifting, going back into the US. So a notable dynamic here. Fixed income, more weighted towards Europe, but again, a building flow into the US. So I felt those were pretty interesting. I'd finish in terms of the setup by looking at just simply US versus world equities. And this is clearly a very long-term chart. You kind of get why there's that ongoing phrase of US exceptionalism. For the past 15 years, we've been in a move of US equities outperforming the rest of the world. There was that period between the tech bubble and the financial crisis where the US underperformed, but before that, again, a period of long outperformance. And so with that as a backdrop, I'm curious to get into you all's perspective and where are you thinking about regional allocations at this point as you look into 2026? Rose, I know you're straight up in the US. I'm going to come to you last to get your vantage point, broadly speaking, but I also want to ask you a twist on the question. But Eduardo, Claudio, how do you think about the U.S. from a globally diversified perspective at this point?
Well, I go first myself. Okay. Well, as you showed in the chart of the relative over or underperformance of the U.S., the periods where the U.S. Outperformed usually were accompanied by a stronger U.S. dollar. And when the US underperformed, it was also in period of weakening of the US dollar. So if we are expecting, because of a reduction in the interest rate differential, that the US dollar might continue to weaken, probably US equities will continue to underperform the rest of the world. And this is also something that might happen if the valuation gap between geographies and most importantly between sectors will diminish. We are at record gaps in terms of valuation among sectors, among styles. So our expectation is that as the earning per share growth rate are starting to becoming more similar across sectors and across countries, that this huge valuation gap will be reduced. And this is another factor that makes us thinking that continuing like it was the case in 2025 to increase the exposure to international stocks versus the US stocks will continue to pay off. And within technology, we are also looking at other areas of the world, particularly Asian tech, where we can have access to the main theme related to the AI developments, but at a much cheaper valuation than the one that we are seeing in the US. So basically our advice to our clients and also what we are doing in global portfolio is to be more diversified in terms of countries and sectors.
Oh, very good. Eduardo, how about yourself?
Okay, so basically we are also underweight in United States due to valuation, as Claudio have said. We also are a bit afraid about this AI boom in terms of investment. I think something has got to give, or the semiconductors or the hyperscalers. It's strange that they keep investing as they are. Probably the hyperscalers are investing also for their survivorship, for their survival. So when you invest to survive your business model, you invest too much. So eventually there will be winners, and the winners, for sure, the investment will be clearly productive, but there will be losers also. And if this survival war ends, you have a more levelized investment on the semiconductors that eventually is lower than the market is estimating. So we are underweight and we are overweight basically Japan and Europe. Japan due to the corporate governance reforms that are accelerating. So they are increasing the ROE and EPS growth. Valuation remains attractive. Yen is super cheap. So it's a good way to invest in Japan with currency unhedged. And besides that, we are also overweight Europe. We believe that besides valuation, more attractive than United States, the fact that the Germany is investing more and Germany can push for the other countries to have higher growth can help Europe. Europe has always a problem of fragmentation, but I think that's on the prices. That's one of the reasons that Europe is much cheaper than the United States. It's political fragmentation. So we believe it's a good way to be overweight Japan and Europe against United States. In emerging markets, we are neutral.
Oh, fair enough. Um, Rose, you are a U.S. specialist. It's interesting to get your vantage point in terms of positioning in the U.S. There's also a question that came from the listeners asking, as you have conversations with allocators as a U.S. investor, a U.S. oriented fund, what are you hearing from the standpoint of ongoing interest in the U.S.? How are they positioning and in those discussions? So it might be interesting to get both vantage points from your perspective.
Yeah, no, thank you. Look, I think, again, the charts you just showed are very helpful in that there was clearly a lot of nervousness around Liberation Day and the aftermath. You know, was the global playbook being ripped up? Was this the end of America's credibility on the world stage? Were tariffs going to have a horrific impact on the US in particular? I'd say I've just really been struck by the resilience of US companies, their ability to absorb tariffs, and many of the ones we talked to have done really smart things with supply chains. They have pricing power, and they're able to carry on doing, being in the business of doing business, which we think American firms do best. Why is that? I think for us, our observation as British and European people investing in the US, there's something quite cultural actually. There's something about that entrepreneurial spirit, that shareholder-friendly culture, and some structural things. I think Eduardo mentioned just the size of that kind of single market versus much more fragmentation in Europe. So there's some really big long-term structural and cultural reasons why we think US companies are so resilient and can perform so well. So, we haven't changed our fund, for instance, to a global fund, despite some conversations with investors, frankly, around whether we should do that. And I think our reasons for that are continuing and enduring themes around America and its structural and cultural advantages. In terms of, I want to pick up a little bit on Eduardo's comments and others, and as I echoed myself, we are wary around valuations, particularly when it comes to pockets and the kind of AI halo, AI exuberance. Obviously, if you look at a market-weighted index like the S&P 500, like that is what you're buying. It's inescapable. That is what you're buying at this point. But if you look at other ways of playing US active funds such as ourselves and our very different positioning, or even an equal weight index or mid-cap index, there are different ways to get exposure to the US that I don't think force you to be very narrowly in 7 companies and one particular theme. So that's just a reflection we've been sharing with our investors. From a market cap positioning perspective, for instance, over 40% of our fund is now in the sub 50 billion market cap space. So kind of undiscovered gems, we think, versus some of these bigger companies that are getting all the airtime and with really rich valuations to match it.
Oh, very good. It's super interesting from all of you all. And look, I would throw out a couple of different reference points that have come up around here with our analysts. One, within the discussion of the AI CapEx boom, and you've got a handful of very big companies spending $500 billion, whatever the number happens to be. It's big and it is scary, but it's also interesting to take a step back. And if you look at generative AI spend, you can cut it in a couple ways, but one is to look at it compared to total tech spending. And it's running right now north of 10%, less than 15% of tech spend. So it is a massive, huge number, and it is concentrated with a few companies. But you have to put it into context. A lot of that spending is happening in part because it's not going elsewhere. There's a reallocation in the tech spend space towards this and less of that. Second point is relative to the dot-com bubble, where the spending was being done by indebted telecom companies and others, these companies are cash rich. I mean, clearly we all still want a return, especially given where current valuations are. But it's not like they're heavily indebted companies by and large that are spending this money. The last thing I'd reference on the AI thing is we've got now I'm front running myself a little bit in a nice way, a compliant way, mind you. We've got a report coming next week that is an in-depth look cross industry of large companies in how they're looking to implement AI. And to us, that's really the key in 2026. Are real companies across the real economy actually starting to use AI? And are they generating either revenue or efficiencies or cost cuts? And if they are, then that helps to justify all the hype. And if we find they aren't, then we have the potential for a bubble. And so that's kind of where our focus is, as opposed to just simply how big is the LLM CapEx cycle. So I don't know if that jumps out to any of you and you want to make a comment about sort of the implementation of AI. I'd happily hear your thoughts if so.
Yeah, look, I'd say, just a couple of thoughts. So the Finney Park Fund actually started in 1998, so we have kind of lived through a few bubbles in this respect. Look, it's not all the same, and we're not claiming that this is a bubble. Even we don't like that terminology; it's quite lazy, and certainly history never repeats. It is true that many of the companies spending now are far more profitable than in that era, but not universally. So, Microsoft was very much hurt by the dot-com bust, for instance, and it took, decade for its share price to recover. So I don't think it's quite as binary as, it's totally unprofitable companies over here back then, and then the reverse being true now. And we see many examples of unprofitable companies spending money or being financed through vendor financing, through debt, even Oracle, for instance, making commitments based on debt, etc. So I don't think it's quite as binary in terms of contrast. In terms of real world use cases, I think this is absolutely critical. We're starting to see a few of those. I think if you'd asked us 6 months ago, we'd have said, okay, when we're engaging with companies in our fund, we're seeing very limited use cases. They're starting to pick up. But I would say that companies aren't generally spending very much to get them there. So that's an interesting phenomenon where they're starting to get some value, whether it's efficiencies, whether it's revenue generation, but they're not spending lots of money because the prices of LLMs keep getting undercut, generally speaking, or there are many cheap options out there. And so I think that's a difficult one for us, because even when we're starting to see these good use cases come through, we don't really understand how that accrues in terms of ROI back to those LLM producers, the infrastructure layer. And I'd say quite a good analogy there would be, the railroads, for instance, where, the railroads transformed economies, right? Every single business could use the railroad better. And it was absolutely incremental and additive to everybody's business models. But many of those companies still went bust because simply too many of them have been built at too high a price point. So yes, we are starting to see some real use cases. They've taken a bit longer, I think, than people thought, but we're still not seeing a lot of money being spent on Gen AI.
Oh, fair enough. Let's keep the discussion going. A couple of things have come up. One being, how do you broaden out beyond concentration? And that's most notable in the US. And Rose, you talked about this a little bit, but I know Claudio and Eduardo, you all also have referenced this, but also maybe take it beyond the US context. There's been discussion about broadening out to small mid-cap within Europe and other geographies as well. And I'm curious how you all are thinking about the opportunity for smaller mid-cap companies. Anybody want to jump in here? Claudio, your mic's off because your headset. I'll pick on you first.
Okay, well, typically small caps tend to do well when there is an ample liquidity. liquidity. So when central banks are actually either easing monetary condition or doing QEs, the underperformance that we've seen over the past few years was basically linked to this phenomenon. We had a restrictive monetary policy, so it was quite normal having small cap underperforming. Also, the additional factor was that this AI theme is clearly something that is concerned centered only in mega caps. So these two factors led to this gap in performance. Now there is scope for closing this valuation gap, but probably for small cap to really outperform, we also need a reacceleration of the global growth, which is something that maybe is not for the immediate future. So rather than speaking in terms of large cap versus small cap, it is really a question on single name and valuation for us.
Fair enough. Eduardo, thoughts from your vantage point?
Well, regarding small caps, we are astonished by the difference in terms of performance. And when this happens, or we have a very big conviction, because we normally are contrarian and we take it, or we just wait for the sidelines for the inflection point. And we are waiting for the inflection point on the sidelines. Basically, I think this theme of AI has mixed implications in terms of small caps, because eventually small caps does not have the money enough to invest to take advantage of these huge opportunities and huge productivity, but also as the LLMs probably are over investing and investing without visible profits in the near term. They are over investing, and eventually they are democratizing this access to these AI tools, and this is good for small caps. So we don't know, so we prefer to wait on the sidelines. There is another sectors that are underperforming a lot, that we prefer to invest as a contrarian view. So we like a lot healthcare, and we start building that position in September and October. And we always liked quality factor. We decreased this quality factor due to basically technical analysis. We have a lot of quant models. We are trying to mingle macroeconomic research with data science, and basically quality we have decreased, but we believe in quality. So it will be easier for us to invest again and be overweight quality, be more overweight quality than we are now, than small caps that we believe there are more clouds in the context.
Oh, interesting. A couple of the recent fund forums that I have to have joined Evenco on, there was a definitive interest in small mid caps and broadening out. So it's interesting hearing some different views. Rose, I know you all have a long history of having sort of an all cap fund, and you already referenced a little bit on going beyond just simply, the big caps. Any other thoughts you'd want to add?
Yeah, no, definitely. Thank you. And I think we just distinguish, particularly in our market, between small and mid. So right now, the small cap index, the Russell 2000, I believe over a third of companies in that index are unprofitable. We don't invest in unprofitable businesses. That's not our jam. We like businesses that are a bit more predictable, a bit more stable. And so we're not really in that kind of proper small cap space. But in the US, you have, as you say, some companies that are not the mega caps, not super large cap, but are real leaders in their industry. They may even be number one in a slightly smaller industry, but are just under that kind of 50 billion, call it, range, that would in fact probably be a large cap almost anywhere else in the world. So we have firms that are leaders in aggregates or leaders in stoppers in the healthcare sector that are really important for GLP-1s, for instance. They're number one or two in their industry, but these aren't household names that everybody has necessarily heard of, particularly from the UK European vantage point. And we think there's huge opportunity there, companies that can be leaders in their niches without that kind of large cap kind of halo around them. So yeah, we're absolutely excited about the breadth and diversity of opportunities within the US market.
Oh, fair enough. So I know I'm cognizant of the clock. I'm looking down at where it is here on my my screens. And two last things that I wanted to explore. This has primarily been sort of a backdrop and an equity-oriented discussion we've had. I guess this is probably more towards Eduardo and Claudio, but Rose, feel free. Where are you thinking from a fixed income allocation at this point? On the one hand, rates are relatively healthy, with a backdrop of many central banks lowering rates. So you think, okay, that's good, but we know as well credit spreads are about as tight as we can ever remember. So how do you think about the allocation towards fixed income within your current portfolios? Claudio, you want to jump in?
Okay, so internally we have increased the average credit quality of our portfolio in the last few months, considering that the spreads are quite tight, and there are, I would say, some signs that there could be sooner or later a slowdown. Nothing dramatic, but that could happen. So as spreads are not wide and do not compensate adequately for the risks that we are taking, we have basically increased the duration. So we got back, because of the shape of the curve, the steepness of the curve, we got additional return by extending duration. And this is also something that we expect that will pay off, because some central banks, particularly the Fed, will cut rates. If there is some slowdown, this will be a general phenomenon. So extending the duration allows us to have higher yield to maturities and waiting for some situation that would cause a widening of the spread, so making bonds attractive again. So we are not cutting all the risk, just reducing a bit, and we continue to favor within fixed income. Emerging market debt that normally tend to outperform during times of Western central banks cutting rate and/or US dollar weakening. And within corporate, we prefer hybrid bonds because the issuer is rated investment grade, but as the issuance is sub-investment grade, we get some extra return from that portion. So it's the best combination for us, hybrid bonds, in this current situation.
Oh, fair enough. And Eduardo.
Okay, so basically, we in our portfolios tend to have a lower exposure to bonds than traditional asset allocators, because we substitute a part of that exposure to our liquid alternatives. We have a very good experience within market neutral long short equities. So part of that low volatility kind of carry return, our carry is alpha. So besides the market rate, so we have a good experience. So we have lower bonds, but given this context, we are in the maximum exposure to duration for the past decade, and we do that duration 80% on with govies, and with govies basically core govies, so Germany, European Union, and treasuries. On corporates, we are clearly underweight and try to be exposure with a lower maturity. So, for instance, we like short-term high yield, we like short-term credit, but we believe, as Claudia said, the spreads are pretty tight. Eventually, if there is some slowdown that can affect spreads, I think we could invest much more in credit spreads, and I think the duration part will save us for the losses that we for sure will have in equities.
Yep, fair enough. Thank you very much. Rose, I won't press you on the fixed income question given where you're coming from, but I would shift gears to the last thing I wanted to bring up. And you all have talked about positive dynamics of where you see things going, how you want to be positioned. To ask the proverbial question of what keeps you up at night, though. What's or a couple of notable risk factors that on your radar screen that you want to be monitoring as you look into 2026 above and beyond others? What would those be? Rose, shall we start with you, if that's okay?
Yes, look, I think we've talked a lot about AI, and as I mentioned, we're kind of cautious on that. We want to really understand our direct exposure, which is very limited, but also our indirect exposure. So companies that are aiding AI infrastructure, for instance, is a small part of their business. What would a slowdown in that spend and material slowdown look like for them? So that's something we're very much kind of keeping front of mind. I'd say we have thought about politics and geopolitics probably more this year than in many prior years. But again, it's important not to get too obsessed or caught up in the short term. Reflecting back to that post-Liberation Day period, one could easily have sold out right at the bottom because of all the political analysis that was coming through, which we didn't do, thank goodness. But I think keeping the longer term view is really important and certainly helps us sleep at night.
Very good. Eduardo.
So basically, something that keeps me up at night is really the complacency of the market. So in our quantitative models, being the positioning is a factor that has predictive power. So I'm a bit afraid about that. Besides that, I think that the growth in private debt can make some hiccups in the market, so that we need to be careful and monitor. So I think, in short, the biggest risks are not so obvious. Normally, they are slow moving. I think a couple of ones we need to be monitoring. So AI spending normalization, also the dollar realignment, and this hidden leverage in private markets could reshape the investment landscape. So our approach is really to stay flexible, try to hedge the most that we can, and for sure try to avoid complacency.
Very good. And Claudio, how about yourself?
I would add maybe one topic that is not very much in the radar of investors, at least there is not that much attention or focus on it. But anytime that we had some countries announcing a widening of the fiscal deficits, we have had long-term rates reacting quite badly. So I suppose that after 5 years since the COVID, when we had all governments resorting to a huge increase in fiscal spending, probably the market is becoming a bit more worried about this that sustainability. So this might be something that could cause some volatility in the next, maybe not yet 2026, but in the not too distant future. So as long-term rates are also used as a reference for evaluating any other alternative investments, I would say that if we would see additional increase in deficit by government, that could be an issue. The other point is in relation to China, because their economy is clearly contracting. The key reason is implosion in the real estate sector, and the government is not showing any willingness to reverse course. So as the real estate sector is still very important for the Chinese economy and for Chinese consumer, because most of the wealth of the Chinese is in real estate, if they not change their stance on this, we could have some further weakening of the Chinese economy that would be difficult to reverse. So China could be an issue, but also an opportunity if instead they will start to support their economy. And as a third factor, but was already touched before, we will have to check whether or not this huge AI spending will translate into real demand outside of what has been, in my view, correctly defined as circular nature of AI so far. Because most of the AI spending has just been companies involved in AI basically buying other services or products from other AI companies. So there was no particular revenue growth or earning growth that was driven by actual final demand on AI. And if this will not translate into real demand, there will be an issue, particularly because those companies will then start to compete with each other in terms of price and margins. And, tech is fairly almost reasonably valued if we look at price to earning, but if we look at price to sales, it is much higher than in 2000. So the fact that these companies are eating their cash flow and or resorting to debt is something that might be an issue if we will not have this demand from outside of the circular reference.
Very good. Well, look, I know we're at time, a minute past. I do appreciate you all's perspective. It's been great hearing your thoughts. I would highlight as well in terms of the ongoing data and insights that Evenco has, you can access on their LinkedIn page. So well worth taking a look, not only with the Evenco analytics data, but also those upcoming fund forums as you look into next year. And certainly as a reminder, if you've got a Bloomberg around your shop, you've got Bloomberg Intelligence, and we'd love to engage and discuss more thoughts on these topics and many others. Rose, Claudio, Eduardo, thanks for your time, your insights, and here's to a great rest of the year and a new year to come. Thank you very much.
Thank you very much.
Thank you.
Thank you very much.